we are going to do something really interesting and really not so common. We're going to talk on financial statement model versus project finance model. Okay, so hopefully a lot of us will get some insight into what the difference is between the two. I think my voice is echoing. Let me see from where. Okay, so what the difference is between the two, and also I'll focus a bit more on the project finance model. People are very much familiar with the typical project financial statement modeling. So I don't think a lot of people will have issues with coming to grasp with that one. So without wasting any more time, I start. Okay, so financial statement models. So financial statement models are the typical models we do. So let me go to even presentation mode, as that will make it a bit nicer. You won't see my next screen until I go there. So, okay, so slideshow, present from beginning. Awesome. Okay, so let's start with the financial statement model. So the financial statement model are the typical, balance sheet. The arrangement, I have it mixed up. Balance sheet, income statement, and financial, the kind of cash flow statement. Okay, so we typically do the financial statement model whenever we are trying to take for a company as a whole, we're trying to take for an organization. And so you find out that you're modeling the entire organization. You're modeling the balance sheet, the income statement, and the cash flow. So I'm going to go to the Excel later on, right? So you're going to see the examples of what it will look like. But whenever you take a company's annual statement, whenever you take a company's financial statement, you are definitely going to see their balance sheet, which is also called the statement of financial position, the income statement, which is the statement of profit or loss, and the cash flow statement. So these are the normal financial statement models. And the interesting thing is whenever you go for a financial modeling class, this is what we take you on, because this is the general one. The project finance is so niche focused that if someone is going to train you on project finance, they will tell you up front. They're going to tell you instantly that this is strictly project finance. They won't give you the general term financial model. So I just wanted to be aware that whenever you hear financial models, not even most, kind of all of the time, it is these financial statement models that is being referred to. Okay, so I will demonstrate in Excel anyway as we go on. And then there's the project finance models. The project finance models are entirely cash flow based. They will even talk about the cash flow waterfall, how people are going to receive money out of the project. So I'm going to start first of all by showing us the typical financial statement model, and then from there I also have an example of a project finance model which I will just show a bit of. Then we'll try and create one from scratch, and maybe we'll spend some more time also before creating more from scratch. I'll spend some time explaining to you the relevance, because that's again something you need to know. Why will a company need a financial statement model, and then why in some other instances will it be a project finance model that is needed? Okay, so let's see how a typical financial statement model look like. So I'm going to, I have to be careful not to not to open anything that is confidential or proprietary. So let me go look for my own model. By the way, if you have any question, feel free to drop your questions in the chat box. I hope you hear me loud and clear. I don't know which mic is currently connected to the system. Let me just do a quick check. But if you hear me loud and clear, please let me know. I want to open up for us a financial statement model. Okay, so here is an example of a financial statement model. Example, this is a financial statement. So like I told us, sometimes we don't say it, but it is implied. So even when we say financial model, well, this is still the end result most of the time. So you find out that this has always income statement in the traditional arrangement. So you'll see there's the revenue, there's the cost of sales, there's the operating expenses, and then it comes to the net income. It has the balance sheet, right? Again, the balance sheet follows the typical arrangement approach, the non-current assets, the current assets, the non-current liabilities, the current liabilities, the equities, and it's also got the cash flow. Again, the cash flow is very much the conventional approach, the cash flow from operations, the cash flow from investing, the cash flow from financing, okay? Then if you want, you can go ahead and do a DC evaluation or any other type of valuation you want. Now, let's talk about why will you want to do a financial statement model. So why? So let's start with the why. I'm going to quickly put in here insert a text box. So why will you do a financial statement model? The why is that when you are creating a company-wide, forecast, you want to forecast the entire company's operations for the next couple of years. It's a financial statement model you are going to do, okay? It could be for loan reasons, could be for investor equity now. Could be for equity. You want to raise equity. And then they've asked you to show them your financial statements. And the main reason you are raising money is to explain to investors, to entice investors, to let them see that there is a bright future, right? There is a future they need to be part of, right? So you'll find out that it's a financial statement model you're going to do that will show maybe for the next couple of years and the valuation, terminal valuation and what have you. So, could be for equity raising, could be for management strategy. So there is a change of management or there is a strategy. Or the company wants to be a bit more strategic with their decision making. So I've seen companies where they want to realign their businesses. They want to play down some aspect of their business, begin to make them be less significant and scale up another aspect of their business. And they want to be able to capture how all of this is going to translate into, on the income statement in terms of the revenue they will earn, how that part they want to grow will keep growing, the kind of operating expenses that will be involved, and then also on the balance sheet side, how their asset mix is going to change, what they are going to start scaling down on, and then what they will need to buy more of. So take for instance when GSK, GlaxoSmithKline, was pulling out of the beverage industry. So they were previously in beverage and pharmaceutical. So now, well, not now, like I think 3 years ago, they decided to sell off their beverage arm. So they sold it off to Suntory Beverages, right? If you are doing the financial, if you are part of the financial planning team, you are going to want to do a financial statement model to show how we are going to dispose of the assets that are related to the beverage side, and then how our revenue that used to come from the beverage product line are going to trickle out, are going to go out of our financials, and then how we are going to become more strategic and increase the pharmaceutical side of our business. So you see, a financial statement model is the right tool to help capture those kind of dynamics, right? So is that clear? Now let's talk about what is even a project finance model. What is a project finance model? Maybe so that as I'm explaining it, you will see some things on the screen. Okay, so let me just jump on Google and say, what is project finance? Let me even write it, modeling. Okay, as it is with me, I like to go to multiple answers at once. So I'm just going to randomly pick some couple of results, and let's see. I think this is good enough. So as I'm explaining, we are working on bringing him to present, Matthew Bernard. So we're still in talk. I can't say anything for now, but it's already open to the idea of coming to present on one of our sessions. So it's based in South Africa, but it does heavily for project finance modeling knowledge share. So it will be a very good thing for us to, for you guys to be able to learn directly from some of the top names in the industry. Okay, so that aside, let's see. So a project finance is usually around financing long-term infrastructure, right? I'm going to come back to this because I want to show you, this is already telling you some of the things I want to tell you later on. So let's go to another one. Okay, great. So this is going to be better for me to use to quickly bring you up to state. So you see a project finance model. Apologies, there's a noise coming from outside. I'm trying to block out. So a project finance model is typically a model around a project. Let's start with that word, a project. So I'm going to go to my writing screen. I'm going to start writing out the keywords. Unfortunately, the way I want it to come up in the online ones are not the way they are writing. So let's just write it out ourselves. If you have any question, feel free to ask me. I will definitely answer. You can chat, you can unmute your mic. And so project finance, this is still coming up. Okay, great. So project finance model. The key thing is, first of all, it's usually around the project. So not a company in the traditional sense, but a project. The project can still, be a company, but obviously a project, right? And usually a long-term project. The project with a predictable cash flow, So you find out that because of this nature, people tend to do this in infrastructure type of projects, where maybe you are building a road that is going to be a toll on. So that's part of the problem that is happening regarding the Lekki toll gate. So we as normal citizens, we feel like that is insensitive. That's what people say. It's insensitive for them to reopen the toll gate. But you know what? That toll gate is a project. It's a project finance type of entity where they have built it up on the basis of predictable cash flow. They're going to be earning, that toll you are paying. They've estimated how many number of cars are going to pass per day, how much they're going to get. And the entire project is going to be sustained in terms of the money they're going to pay back to the funders, and then type of the entire returns that those who are equity contributors into that project will get. So when you are saying they shouldn't open it, they are seeing problem. Problem one would be that they might not be able to repay the lenders. Problem number two is the people whose money are in it as equity, their money is going to disappear. So nobody wants billions of naira to vanish, just because some of us are not happy. So it's a business thing. But the key thing is Why it's so much of a problem for them is the fact that it's creating an issue around their model. They've been built around predictability that we're going to be earning this number of money at this toll gate, on a daily basis. It might not be accurate, but they do it in such a way that that's why we have scenarios. So they've done it in such a way that, well, even when they miss on some days, some other days cover for that. So they get a very good average to use. Consider that versus a complete shutdown of it, it's already, I think it was in October we protested, right? And then it's almost, was it October? Well, it's already more than 3 months, let me use that word. So the key thing I want to bring out is it's always around projects that there's a predictable cash flow. So you find out that if it's in the oil and gas, they start talking about negotiating some off-takers kind of contract. So even before they start, they begin to negotiate with the people who are going to buy, who are going to pledge to buy what we are going to mine. Maybe we are mining gold, we are mining oil, we are mining some other natural resources. We already know the kind of quantity. We've done our geological and all those other things that needs to be done to have a good estimate of what we can be able to mine, process on a daily, weekly, monthly basis. And then we are going to negotiate with buyers ahead. In fact, sometimes you try to get the buyers to fund you. So that's why you will notice there's a whole lot of projects that is being constructed by Chinese construction, CC, China, civil engineering and blah, blah company. You know why? Most times they are the one funding the project. So because they are funding the projects, they're able to lock in and say, you know what, we know that in our native country of China, we have need for these raw materials. We have need for lead. We have need for copper. We have need for gold. We have need for, granite. So what are they doing? They are saying, we know that we can sell directly at our home country. So we already have ready-made buyers. The same thing even for power, energy, in the infrastructure side, the energy side. Again, we have a national grid. Everybody knows that we don't have enough power, right? So what is a company who is trying to set up a power infrastructure? They're going to use a project finance model. One, it's a big project and there's a predictable cash flow. So if I know that I can produce, I'm going to set up a power plant, it's going to produce a 100 megawatts capacity, that is a 100 megawatt capacity, and I can be able to sell, all of what we produce to the national grid, then I can predict the cash flow. We already have an idea of how much it sells per megawatt, per kilowatt hour, right? So there's always that predictable cash flow. That's what makes it drastically different, or well, one of the things that makes it drastically different from the way we model our financial statements, the other side. This one is cash flow driven. We know how much we can earn. We try to know exactly how much we need to spend. So that brings us to, so it also captures, what is the Opex and Capex. But we know what? We draw this from the cash flow plus whatever funding that we are getting. So unlike the corporate finance statement, where the cash flow is like the ending, is like the end of some many other activities. This one, cash flow takes center and take the front stage, right? So in a project finance model, right, we are, let me scroll a bit. It's always around the project, infrastructure projects, something that is obvious that infrastructure. It's obvious that there's a need, there's a demand, there are going to be buyers. So it's not going to be like I want to set up a company and I'm not sure what the future is going to be like, but we are going to be very nimble. If we notice things are not going this way, we'll change that. No. For a project finance model, it's always around projects that are defined. That's why they call them projects. The very meaning of project means three things: the time, there's no guessing around the time. is quantified in terms of resources that you're going to use, and then you already also know the kind of quality too. So, well, like we say, there's the time, the resources, and the money that you're going to, and the output, let me use that word, and the output that is going to come out. Okay, so the same thing too. When we say something is a project finance model, it means it's around the project. It's something that you already know how much resources you're going to really need. It's very well quantified, how much you're going to make out of it, and the time inside of it, how long it will take to construct. So there's always also in the project finance model, you might factor in the construction phase, the operation phase. So in project finance models, we don't always assume that the entity will exist forever, and that works naturally, works according to the natural nature, works according to the nature of some projects. Say the toll gate, right? I think they say is it 25 years or 30 years concession. So everybody knows that at the end of a period, we no longer collect toll. It becomes a public free road, kind of. Okay. By then, they should have recouped whatsoever money that they have put in and gain that they are seeking to make. So even though the road is not going to be destroyed after that number of years, but as far as the commercial side of it, for the people who are building it, the people who are investing into that project, they know that it's a fixed duration of time. Okay. So there's always a termination. So this termination can be natural or can be what we call terminal value, just for which makes it logical. So for instance, real estate, if you use a project finance around the real estate venture, even though you're not going to now start saying people there should start living in the property for free just because your model can only account for a number of years. No. So what we tie it to sometimes is the timing you have promised your investors. So I've had to work on something for a real estate development firm, one of the subsidiaries of Actis actually, and what they did is they matched the timing with the fund duration. So when they go and raise money from investors, right? So they could raise it as a 10-year fund, as a 15-year fund, right? So what they do is they match it, the same thing to that Helios investment does. So Helios investment too, they raise money, they have different rounds, different fundraising events they hold, that they raise it for some specific projects. And so what they do is that even though the company or the entity that the project that they are putting this money into, be it a real estate project, an infrastructure project, the project is going to keep on till maybe they have raised it as a 12 years or a 15-year funding duration, right? What they do is they apply a terminal value. They try to exit. So maybe they find somebody else to sell to, or they try and maybe they sell to another batch of investors, but they always try to exit. So in exiting, in the model, we have to capture that as terminal value. Okay. So there's always a termination. You can never say the project is going to be an indefinite one. You have to factor in that maybe it's natural. If it's a gold mine, if it's an oil and gas mine, all the oil are going to finish anyway. So you will know this thing is going to last, by the way you are, with the rate you are mining it, it will deplete completely in 30 years. And then voila, that will be your termination period. In fact, you might spend money to decommission the mine. So that also has to be factored in. Okay, we have to decommission the mine. We have to, make it due to local regulatories and all, make it non-toxic, make it better, how will I call it now? Like instead of all the holes we've dug and all, begin to fill it back, make it, in a residential place, something good for other people to stay in and all the rest. So you might even incur money, unlike some businesses that you'll be selling it according to your terminal value of your model. Okay. Then there are always covenants around it. Let me write. So there are always special covenants around the funding. Okay, so because a project finance is typically funded by debts, heavily debts, and could have equity, but most of the time the equity component is usually not much. It's always most of the time debt heavily funded. Okay, and so it's a what we call non-recourse loan. So the loans you get, non-recourse loans mean that the bank giving you the loan, right? They cannot seize anything outside of the project. So say you are company ABC, you are proposing to go into renewables or go into, maybe not even renewable, you're going into the energy space, you want to set up a generating plant. So you want to go through the route of project finance. You want to finance it off your balance sheet. You don't want to tie it, so that's why it's also called a non-recourse loan. You don't want to tie it to your company's balance sheet. You want to fund it as a separate entity, So what do? You get some people to bankroll you. So typically you might get a bank that is very experienced in that nature of project, and approach them, and you know what, they're going to help you even flesh out the reality of what it goes like, give you some insight into that nature of project, and more importantly, they are going to, hopefully decide to put in the money that you need, as debt. So what happens is that if anything goes wrong, they can only lay claim to the assets. They can only lay claim to the plants, to the, what has been bought, in that project. They cannot come after you and decide to want to come and seize your company's assets or try to get the money out of you. All that they can lay claim to is going to be that entity, that project, and whatsoever assets that are in that project. So that's why for you, that you are the operator or you are the initiator of that project, let me use that word, you are doing it off balance sheet. You're not tying it to your company's balance sheet anymore. You're separating it. You're separating the liabilities. And then for the bank, it's a non-recourse loan. They cannot hold anything outside of the project. So they want to be stricter. So then being stricter means that they're going to set up things like debt service reserve accounts. Again, I'm going to try to show us how some of this looks like in the Excel. Debt service reserve accounts. They include things like conditions that you cannot do any distribution to equity until the loan is paid out. So they could say, equity guys are never going to get dividend until the end of the loan that they've given, when all of the loan is being paid out. So they give targets. So they could say there's going to be a debt service coverage ratio. We're going to talk about this coverage ratio later in further future sections. Debt service coverage ratios. So they're going to want to ensure ratio. They're going to want to, so they will create a minimum or a limit to it. So they might be like, we're only going to put money in this project, only if you guys will always be not less than 1.4 of your debt service, your cash flow available for debt service, CFA. I don't want to talk too much about the technical things, but let me just quickly go back to here. So I like the way, so that brings me back to this place, the key concepts, the things that underline a project finance model. So it revolves around financing of long-term infrastructure. I've explained that. It is typically limited or non-recourse finance. I've explained what that means also. So for the financier, they cannot lay claim to anything beyond the assets in that project. Okay. It is therefore highly structured so that the risks are mitigated. So for the banks, they put in a lot of covenants. So they could say, you know, you must show that you've gotten long-term buying contracts from some of the people who are going to buy what you're producing, so that they will be sure that you have sellers or buyers already. They might also require that no equity guys are able to take dividend until the loans are paid out. They might put in some ratios and say, you know what, you must always have a reserve account, a debt service reserve account, where you're going to put in maybe 1 year or 6 months debt service money. So, and also they could say, we're going to measure you against a minimum debt service coverage ratio. Again, I will talk about the ratios on a different webinar. So they put in a lot of we call them covenants, a lot of terms in the loan terms. Let me use that word. So that is simply because they are non-recourse loans. So they have to try as much as possible to mitigate their risks. So the debt and the equity, are paid from the cash flow generated by the project. So that's why I told us that this is entirely cash flow driven. It is not like our normal financial statement model, where you can start talking about revenue, cost of sales, the operating, and then you begin to talk about balance sheet and all. This one, even though we're going to do that, but we are talking about them in the terms of cash. How much cash is coming in as revenue? How much cash is going in as direct cost? How much cash is going out as direct cost? How much cash is going out as Opex? And then how much cash is going out even as Capex? How much cash is going out to service debt? How much cash is going out in every nature? So we are listing all those things to come. So it looks like a waterfall. The cash that comes in, how much flows to settle, for some needed obligations like cost of sales, what is remaining after that then goes to settle Opex. Then what is remaining after that adds up with equity drawdown and debt drawdown to settle for Capex. Then how much more is left after that to settle for debt service? Then, so we have terminologies that are strictly for project finance. Like one major one is the CFADS, cash flow available for debt service. We're going to talk about it later anyway. So the debt recourse is limited in project. I've mentioned this, right? Most large infrastructure projects are always financed as project finance. Because of the off-balance sheet funding. So it's separation of the company from the project, so that nothing happens to the project that jeopardizes the existence of the company. Okay, and then long-term debt anyway, because they are long-term infrastructure projects. All right, so you've gotten that. So sometimes it can lead to the creation of an SPV. So most times you might want to create that entity as an SPV, so that it's legally different from the company that is setting it up. Okay, so let us see one of such nature. Then if I have time, I can try and recreate one from scratch. But let's see, because of confidentiality, I cannot show you real client work. So I have a couple of project finance models that are built for a real client, but I cannot show you. I cannot even attempt to even flash it on the screen. So, but this person, so let me see if I can get you the link for this person, X. So he's been generous to share, though it's very old and the structure is not the structure that I will advocate for. But like they say, something is better than nothing. So until I create one that is completely dummy that I can share with you, then we have to make do with the one that somebody has given us for free. I'm looking for Okay, I'm going to upload it manually and share the link to you. So I can do that later anyway. Okay, I can do that later. So let us just quickly take a look through it. So you see, there's always the inputs where you capture when is this project going to start, what is the construction phase, construction start, construction end, and then what's the frequency at which you want to do the forecasting. So we're going to, maybe when I create one, we'll see how whatever I get to by the time we'll be okay with that. Then all the components that go into the project entirely. So all the inputs, so there will be a sheet for the inputs, you know. So I think this is a power related project. Let's see. I think so. So then there is also the breakdown of the kind of operating expenses that we're going to incur. So again, they are broken down, the things that are going to form a larger chunk of the operations, you know, operating expenses and tax. And again, the financing, so the terms that go around the financing they are raising. So what's the rate? When is it going to kick off? Are there moratoriums? You know, are there any terms that you need to capture in there? And so let me quickly share this with us. I'm going to close this and then I'll share, then I'll see. I'm going to have somewhere that if I upload it, I can be able to share with you. It will have been nicer to share the link of the guy, but since he put his email there, I think I'm not breaking any rule. Just don't delete his name and his stuff from there. He's been nice enough to share it openly. So until I create mine, we just have to respect his wishes or do what is right. So let's see, I think it's uploaded. Okay, so I'm going to copy for us the link. So at least you can take a look at it. So I will try and do the approach I use. I'll try and do from scratch, but I bet you I can't finish. So, okay, so people have sent messages. What is SPV? SPV is a special purpose vehicle. But it's not vehicle as a vehicle. It just means a project finance model. So I have, say, about 18 minutes. Let me see what I can create for us from scratch, right? From scratch. So I've shared that one. You can check the link. So I've shared it. You can take a look at the chat link, and you'll be able to see. You'll be able to see and download it. So I want to create from scratch. I won't be able to finish, but wherever I get to, you'll be able to understand the thought process that goes into project finance. Okay. So you can see my screen. I hope you can see my screen. Let me check that. Okay, awesome, you can. So if I'm creating a project finance model, right? What are the things that I normally do? So I normally create a summary, or you can call it cover. I normally create a summary sheet. Let me use the terms I use all the time. And if you pay me well enough, I'll create a user guide. And there's always the inputs. So the model inputs. Then there are the scenarios. So I also create the scenarios. I hope you can see my screen. Let me zoom so that maybe it will be bigger. Okay, great. So I create scenario sheets. let's just call it scenarios. So typically, you want to show what the revenue, Opex, and profit is, so that at least we can see the profitability. So the revenue, Opex, and profits. So this would be like the equivalent of the income statement, but it's not. It is not an income statement, but it's going to be very much like it anyway. And then we also always want to see the Capex, the breakdown of the Capex, right? On the revenue, Opex, and profit side, let me not talk too much so I don't confuse us. So there's typically you want to see the Capex breakdown and whatsoever you are deciding to do for Capex, okay? And then the debt, the funding anyway, so whatever money you are raising, so the debt and funding, the terms that come with it and how all of that go to. So pretty much the major results is going to be, you want to have a cash flow that shows like how the money flows in and flows out, and there's going to be a chart that we all can see and see the nature of the cash flow, and then we can compare it with even the debt we have, the debt service, how much we are using to service both the principal and the interest for the debt. And if you want to do a debt sculpting, so there's also what we call debt sculpting, how you align your debt service to be in tandem with the nature of your cash flow. So there's a whole lot of terminology that is unique to project finance. Debt service. Let's start from the first one, which is the cash flow available for debt service is one key thing. The debt service itself, which is the principal plus the interest cumulatively of whatever number of loans you have. Then also there's the DSCR. So that's the debt service coverage ratio, which we can use to sculpt even the debt service and say, we always want our CFASD, cash flow available for debt service, to be maybe 2 times the DSCR. Again, don't worry about that. I'm just name dropping things. And then we typically, the financials will put that you should always have a debt service reserve account, DSRA, and that you should always do a sweep. So you have to be good with doing cash sweep. So all these things, maybe I'll pick one concept a day and do in future edition. But anyway, let's see how much we can do within the time we have left. And usually the ratios, okay? I also, sometimes I put my charts in summary, and let's leave the charts in summary. Or some other times, let me just do some other times. let me do the one that is the most verbose, where I have a dedicated chart sheet where I'm showing the charts of hello? Sorry, as it is in Nigeria now, even the connection that you are sure of can fail anytime. So sorry for that. So I want to do as much as I can do within the time we have, right? Okay. Some people's background. Let me see who they are and meet them. I think I've seen whose PC is. Okay, the person has muted. Awesome. All right, so let's see how much we can do in the next 12 minutes, right? So I'm going to skip summary because summary is always the last thing you do, right? So I go to input, right? So typically all the terms of the project are in the inputs. So inputs, I have this nature of always wanting to create a why I'm not talking at this point is this one has nothing to really do. It's a pet peeve. So that's why it's not part of our model. So inputs. Okay, so this is the project inputs, or these are the project inputs. So they are create a period start, period end, the year. So most projects are never really done to be entirely 1 year. So you in your year, in your period. So you either do them monthly, quarterly. Quarterly is much more common. So I'm going to do this one quarterly. So I'm going to just do that. So the project timing. So the project timing parameters. Okay. So for the project timing parameters, so when is the model start date? The model start date, this project finance model, when is the start date? Or should we say project start date? Project start date. Okay. All right. So then what is the model period that we're going to use? So what model period are we using? Are we using a monthly, quarterly? Then what is the, I'm going to do something I like to do, right? So I'm just going to do the annual, I call it annual to period conversion. But it's not compulsory, it's just me who, I just like it, it's nice. Conversion. Okay. So now, the thing is, what is the total number of years that this project is going to be? So project duration, but in years, okay? So in years. And then we can now start with the, what is the finance so when are you going to get the money from the bank? So when is the financing close going to close, okay? Which will kick off the money that you're getting from the bank. So there's also the construction start. So most projects always have a unique construction start when you are doing construction and you can't get revenue. So there's always a construction start. There's also the end of construction ends, end dates, construction end dates. And operation starts. So when will operation start? So operations typically means when we start earning income. When we start getting revenue, we are now, the project is now operating, right? So operations end dates. Operations end dates. So these are one bucket of inputs. Okay, so another category of input will now be the revenue parameters. Okay, so if this is an energy kind of business, so what is the let's say what is the daily production, daily generation, say in megawatts. Okay, so this daily generation, at what price per megawatt hour are we selling it? Are we selling it to the off-takers, to the whatever the people we have agreed to sell directly to? So what is the price we are selling at? So the price, I'm just going to say at, maybe we'll use kilowatts. In a lot of times, most big projects are sourced in dollars, so it's not uncommon that most of the project finance stuff I come across and work on, they are not usually done in naira, because that kind of money most times it's not funded by our, even if a Nigerian bank is going to be involved, still it's usually in dollars kind of. So let's say price dollar per kilowatt hour. Okay, and then so maybe these are the parameters relating to the revenue. Okay, also to the capacity. So maybe it's an independent plant. So the capacity, generating capacity. And we can say capacity utilization. So how well are we generating close to that maximum capacity? So that allows for flexibility. So we can create periods and say we're going to always have a shutdown, a maintenance that will involve some kind of shutdown, maybe once every 6 months. And in that period, that point, we could just reduce the capacity utilization to allow for that and make it easy for us to account for some of those things. Okay, so I'm going to, what other things come in place when you are doing, well, anyway, let me think, if you think about it, the capacity, the daily generation, the price per kilowatt. So that brings us to the end of the revenue side. So we can go directly to the Opex. So the Opex parameter. So the Opex parameters, we might be paying a yearly fee to NEC. So there might be a yearly NEC fee, that is based on the type of plant we are operating. So they charge differently based on whether you are doing renewables, or you are doing hydro, or you are doing which is the other one, or you are doing gas turbine. So there is that one. Then we could, so sometimes people might peg it at Opex per megawatts. But when you know fully the breakdown of the project, you can go more granular than that. So you can go as granular as laying out the actual, number of staff you're going to need and all, and these and things that will make up the general and admin expense and all. But when you don't have that information, you can look at similar projects and see and take a flat rate to say, this is typical Opex per megawatt, So What other thing can I just, so I don't have time. That's why I've decided to use that broad stuff. Okay, I'm going to just I'm going to leave that part and move on now to the Capex. So for the Capex parameters now, right, we have to write out so maybe the plant, we are going to create, maybe we're into renewables, okay? So maybe for us, we're going to set up wind turbines. So a wind farm, a wind so there will be a specific pattern to how the expenditure will happen. So we are going to build a wind farm. We're going to, what other things going? We're going to set up the transmission line that will get to the transmission line to grid. What's the time? Oh boy, 3 p.m. already. I think I might just have to stop around here and continue another period, or maybe I'll just finish the input side, because the input side gives you a flow of how the money is going to come in. The money is going to come in as via the revenue. It's going to go out through Opex and Capex. Let me just name it as projects. But once you download that one I shared, you can begin to see the similarities, right? So what I'm going to do is I will just finish one aspect of it. Let's even see how all of these typically translate. So if I say this project is going to start on 1st of January 2021, okay, and the model periods we are going to do quarterly. So this model period that I'm writing quarterly, is that the spelling of quarterly? Quarterly. I can do better. I can go in here and say data validation list, and say we want to be able to switch between semi-annually, quarterly, monthly. Okay, so I want to give the user that option to pick, and then I can say here a switch that will monitor here. So if this is semi-annually, then that will be 6 months. Yeah, that will be 6 months. Or what's the best way to capture it? Well, we can always change anyway. We can always, okay, no, that will be 2, since I said conversion to annual, so that will be 2. And then for quarterly, we're going to divide how many quarters in a year, so that's going to be 4. Okay, so that's going to be 4. For monthly, that's going to be 12, right? That's going to be 12. Okay, good. Project duration, say this is going to be a 20 years project. Okay. When I do this in real life, I format this. I go to number, I go to custom, and then I put the years in front. So it looks nicer. Let's even stay with this and see how this translates to how I normally try to leave enough space for comments and some other things. So I might start at column, so I start at column H, okay? So we have said the project starts. So project starts is going to be equal to project start date, obviously, okay? So that will be equal to the project start date. And then the project end, the period end, I mean. So the period end is going to be EO month, right? The project starts, and then we are going to use the periodicity that we have done. So it will be, if I pick the quarter, then it should go by how should it do? So let's think about it. If I pick quarter, how many months are in a quarter? Okay, perfect. So it's going to be, we have how many? It will be 12 divided by the periodicity. Let me just use that. 12 divided by whatever is here. I'm going to lock that part or sum. So it should go in that, and then just -1. I hope that works. Let's see what comes out. And if I say you format it, okay, so that worked fine. Okay, good. So what year is that in? So that is going to be, you know what, let's just use the year of, there's something else I used, but because of time, let's just use the year of end of the period, and the days in the period is going to be equal to, well, the end -1 plus, because it's inclusive of that start, so I have to add back that one. So that gets us exactly how many days in that period. I like to make it central. So this one is going to be equal to this plus 1. So every other thing I can drag. So this will get us, the 20 years, or drag it to the number of years we want. Okay, so I normally like to put this in a, because I'm going to turn off the grid line. So I normally like to put it in the outside border, so that by the time I turn off grid lines, it's neat and shows. Okay, so you see it's beginning to take shape gradually, but I have to stop here. So maybe another day we'll continue. I've really gone above time. So any questions, at least from the part I was able to demonstrate for us? Okay, I can see someone's hand is up. Yes, sir, Mr. Charles. Hello?
Hello, do you hear?
Yes.
Okay, good afternoon, and thank you for this.
There's a lot of echo.
Oh,
I don't know if it's...
Is that okay now?
Let me see. It's not my
Okay. Is it still on or it's out now?
Hello? Okay. Let's try to say what you want. Maybe we'll hear your voice above the echo.
Yeah,
okay,
let me
I think it's better now.
Yeah, I think. So let me just go straight to the question. Actually, I've built models, but I've not been fortunate to build a project finance model. So I've actually been learning a lot from this. But what I wanted to ask is that much of your explanation seems to be the model from the buyer side. You see, assuming we have a construction company that is going to build, a project that is going to build maybe a property or whatsoever. The project, the model, is it going to take the same shape, because in that one we know we are building it, we're going to get revenue, there will be some expense and all of that. But in your experience, is it going to take this same shape?
So if I got the question right, this one seems to look more like on the buyer side, the person who wants to buy into the project, right?
Yes, correct. So what of
Okay.
it is from the seller side, the person who will bring the laborers, bring everything, build it. He's expecting you to pay for whatever you have borrowed from the bank and all of that.
Okay.
How would that look?
Okay, I think I got it now. So in the project finance, there are always two parties and there can be three parties. So, but definitely there will always be two parties. So party one is the financier. So party two is the operator, the person who is going to operate the project, and sometimes under party two, you could further split them. There could be the technical partner, and then there could be a non-technical partner. So where this comes a bit more like is, so let's even talk about this more straightforward one. Let me not talk about this. This, like for one of the ones I worked on, it almost split into this, where on the operator side, there were two partners involved. So there's like a technical partner, like one global company, and that's what they do. So their own risk is very, very minimal. They are not putting equity, they are not putting anything. They're just going to partner to commit their expertise and take some bit of profit sharing or take some fees and mixture of profit sharing. So that's like that. No risk in terms of the financial side, but they are not paid based on like we are paying you. They know their payment is going to come off the project, maybe profit, some percentage of profit or something. Where the non-technical is actually more like the risk-bearing partner. But let me just knock this side off. Then, so now with this structure, it's always the financier. There's always a financier. Could be a bank, could be a body that knows what they do. So it could be a private equity firm. Like sometimes that's what Helios Investments do. They are going to finance. They could look for an operator, or they can partner with an operator. Sometimes if they find a gap somewhere, they find there is a gap in renewables in Nigeria, they can go and look for a competent operator and put the deal together and be the financier. But they are always still involved. So the financier is always still involved. It's a very close-knit relationship in the end. So now back to your question, there are no two. It doesn't really have a buyer side and a seller side, because what happens is everybody is using the same model, because that model is what we used to agree before we even go ahead. So typically, the bank usually try to do theirs first, or even if they don't do theirs first, they always do their own. So they will do their own, and if you have your own as the operator side, then you can begin to debate theirs and begin to adjust their own inputs. Maybe you feel they're using two very pessimistic inputs in terms of maybe production, or they are being too strict with the terms. So some could say, you know what, they want you to do a 2 years reserve, a debt service reserve. So when you do yours, you can begin to force them and show them that, you know what, things are still going to work well without you being this Draculian. But there's always going to be one model that everybody is going to take as a benchmark. That when you are even signing in, when the operator and the financiers are beginning to firm up the contract, that's always what is being debated. So when they are having a meeting, that's what will be on the big screen that they are exploring. So the finance guys on the operator side will be able to explain, and but there's always one. It's not so much like the financial model where I don't have to show you the input to my model or show you my model. I just do a nice PowerPoint that explains what I think, and then I give you the figure, and then start negotiating in terms of But this one, because it's almost like a marriage, both of them are going to be in it together. So even usually too, the financier will put one of their persons in the it could be a non-executive director role, but there will be somebody who is also from their own side who is going to be, putting out a bit in the operations of the, let me just say, doing some bit of being the eyes of the bank in it until their own money is out of it. So they don't just leave you be. They know that their money is going to come out from what all of us, our money is going to come out from what is coming out of the project. It's not like there's going to be an exchange right now. If I'm doing the normal financial model, sometimes for some people, maybe they want to sell up their own share or like kind of divest. So you find out that, it's a kind of a one-time transaction. You sell off, the other person pays, you cash out, it's done. But this one, the money is going to come out from both of us. We're going to get our money from what happens into the future. So the only thing I can do is I try and make sure that both of us are on the right path to that future, making sure that there is no unpleasant surprises. I don't know if I tried to answer it the way you prefer. I saw another person's hand up, Mr. Ife. I saw the name as Ife something. Are you still here? Yeah, I think it's Mr. Ife Olukowi. Do you still have a question you want to ask?
Yeah. Okay, the question I wanted to, just clarification, especially when you said like a project has to have an end date. The Lekki Toll Gate project, are you saying that those that built the model for that project had an end date in mind? Because in my head, yeah, I expect that it's still going to keep running. Or is there going to be?
They even publicize it. I think somebody here might even know better. I think it's a 25-year concession, right? We can Google it how many years it is, but it's always a set number of years. After that, it becomes a Lagos State property. It becomes a public property. Lekki.
Okay, now I see what you're trying to say. So this is on the part of the financiers, right?
Yeah. So whatever money they have to recoup is going to be within that period.
Oh, okay. Now I get it.
It's a 30-year concession. Can you see? They even made it public. It's something that is a public knowledge. 30-year Lekki Expressway Toll Gate concession. If you dig deeper, you even find the financiers. You'll see it's at that time it was a very big project that it was some aspect of it was really public. There were like public information.
Okay.
So
then I have another question.
Okay. Yeah, your question.
On average, how long will it take you to build to this model that you're starting from scratch? How many hours or how many days does it go? Depends on the kind of project, if it's oil and gas, if it's infrastructure.
It takes it takes 2 weeks. When they give me all the data, all the structure, it takes about 2 weeks. Because the thing is, this one doesn't have a template that, except if you're going to be for very similar project, that's when you can say you're going to take the one you did for this one and adapt it. But most of the time, you find that it's just, if they are not similar projects, it's just better to start from scratch. So you don't go and do mistakes because they are very sensitive. These things are, the room for error is usually low. If you make mistake, it can be very damning, the consequence. So, and if you're a client, if you're a consultant, it can damage your reputation. It might even mean they will no longer take serious. And companies paying by milestone, they might just yank you off and like rather cut their losses and look for another consultant that won't make mistake. Except if you are already very big, that they just know, they will just request that you give them another resource rather than you who has made a mistake. So, but 2 weeks, kind of, if you are doing it like steady, like it's not like you are doing it only on evenings. You are working on it steadily, let's say 2 weeks, because there's also the error check, there's the dynamic aspect of it. But maybe the first draft, if you already understand the project, because that's the other thing. If you understand the industry, so you know all the inputs, you can be fast and 1 week. But still, because you have to do checks, and scenarios here are always bloody. The scenarios here are many. Financial model, you do maybe one best case, base case, worst case. This one, everything has to have its own scenario, oil price or exchange rate or everything. I can't do one kind of a drop down or combo box and say it should apply to all the inputs. No, all the different inputs you have to create. Some input might have 3 scenarios, some might have 5 scenarios, depending on the owner of that domain. So the person in say maybe who understands the generation side of it might say, you know what, we understand that things are very dynamic with this and blah blah. You know what, don't put you want type of utilization, don't even put 3 levels of utilization. Want to put 5 levels of utilization. How well we are using producing at the capacity of the plant. They want you to put 5 different levels. So they won't just want you to say best case, base case, middle. So that one takes time too. But it's very interesting because almost every major aspect of the company will have to explain. You will end up knowing that industry by the time you are done, or knowing that company, because it's very, very granular. Okay. I think we will have to start wrapping up. The next session that we have is a foreign guest, and I need to be in the session before him so that I can help him test his setup. So this is the session we have coming up next. Maybe I'll just quickly share the link to you all in case you are interested. So that way you can also join. But I have to end this one here. I am happy that at least from today's session, I can see a lot of interest. So maybe what I will do is I will take time to build out something already built out, so that it won't be this one that I couldn't do too much in terms of the practical side. Maybe I'll pick something I can finish in 1 hour and then focus on it. I think maybe I could talk about reserve, because that's one common thing people like to know. How do you set up a reserve account and do cash sweep? So maybe we can do reserve and cash sweep together. Maybe another time I'll break it into components anyway. The problem is if it's a case of that I don't have data project models that are confidential, I will have shown you live one, but unfortunately, until I build a dummy one, which I never thought of until now, maybe you'll have benefited more from today's session. But it's good, at least I can see the interest, so that is going to be motivating me to try and do a dummy one for us. So thank you very, very much. I will have to end the session now so that I can quickly get set for the next one. But I appreciate your joining, I appreciate your staying to the end, and I appreciate your feedbacks. And I hope to see you next week. And if you're interested in the Excel and Power BI, then to see you 4 p.m. and 6 p.m. So thank you very much, and have a nice rest of the day.